Welcome back. Did you know the earliest accounting records actually date back over 7,000 years? Today, we're tackling a massive topic for anyone aiming to absolutely crush their IGCSE Accounting 452 exams, and that is mastering clubs, receipts, and payments. Think accountants are just math nerds? Well, we're actually more like financial detectives tracking down missing pennies. This module we're covering today is literally the architectural bridge between simple data entry and high-level financial intelligence. So if you want your reporting skills to be rock solid and completely transparent for interested parties, like banks or tax authorities, you are in the perfect place.
Okay, let's dive into this. Here is our clear 4-part roadmap for today to help reduce that exam anxiety. 1. Core concepts and terminology. 2. Executing the T account. 3. Evaluating ratios and profit. And 4. Avoiding common exam pitfalls.
Right, let's jump straight into Section 1, Core Concepts and Terminology.
So, for the 2026 syllabus, Cambridge has completely overhauled its vocabulary. The old terms are officially out. You're now required to use modern international phrases like irrecoverable debts and owner's equity. Consider this a non-negotiable requirement for top marks. You also need to confidently define words like accrued, prepaid, realization, and consistency when you're applying them to complex business scenarios on the paper.
Now imagine we're looking at a whiteboard mapping out a local sports club trying to secure a major bank loan to renovate their clubhouse. Everything hinges on these golden rules. First, the duality of every transaction. Basically, every action has an equal and opposite reaction in the books. Then there's the business entity concept, but I really want you to focus on this third rule, the prudence concept. Think of it like this. If you know a notoriously flaky club member might not pay their hefty annual subscription, you simply cannot count that money as profit yet. Never overstate profits by ignoring potential losses. Violating the prudence concept destroys the integrity of your records, and trust me, the bank won't trust your data. The absolute bedrock of all this financial detective work is the golden equation. Assets equal liabilities plus equity. This must remain perfectly balanced at all times during the fiscal period. It's the foundation for everything we do next, because if this equation is out of balance, the club's financial foundation is cracked, and that bank loan is history.
Moving on to Section 2, Executing the T account.
Let's move to the mechanical execution and see how this builds. If an exam prompt uses the specific command word prepare, it absolutely expects you to follow this exact sequence. Identify the correct source document, like an invoice or a bank statement, record it in a prime entry book, post it to the T account, and finally extract it to a trial balance. The goal here is a seamless, 100% accurate flow of documentation right up to the final financial statements. Now here's where students frequently trip up. You have to clearly distinguish between balance B/D, which is the balance brought down from a previous period, and balance C/D, which is the balance carried down to the next. Confusing these two will immediately derail your double entry system. You simply can't master clubs, receipts, and payments without having this fundamental T account structure practically memorized. It remains the gold standard.
Listen, if there's one exam strategy you take away from this entire explainer, let it be this: secure your method marks. In the IGCSE examination, examiners are desperately looking for your logical flow. They will actually award you points even if your final balance at the very end is completely incorrect, provided they can clearly trace your logical steps. So you must show all your workings. Whether it's a tricky depreciation calculation or a weird inventory adjustment, show the work and get the marks.
Okay, Section 3, Evaluating Ratios and Profit.
We are now entering the boss-level skills. Now, what's really interesting about this slide is, imagine you're looking at a past paper, and the command word is evaluate. You calculate that our local sports club's current ratio has fallen from a very healthy 2.5 to 1 straight down to a highly concerning 1.1 to 1. Let's pause right here. Treat this like an active practice session. Why did the current ratio plummet so drastically? What specific financial decisions caused that liquidity to just evaporate? Pause this explainer right now and mentally formulate your response before we reveal the answers.
All right, did you catch the reasons? To secure an A star, you can't just write, "they lost money." You must be specific. You have to state that inventory was overpurchased, tying up all our liquid assets, or maybe trade payables are being settled way too slowly, or perhaps cash reserves were completely depleted by a massive capital expenditure, like buying that new clubhouse roof we mentioned earlier.
That is the exact analytical depth the examiner wants.
Also, keep in mind that inter-firm comparison can be exceptionally tricky. Different accounting policies make it hard to compare apples to apples. One club might use straight-line depreciation, while another uses reducing balance. So you have to look beyond surface numbers and weigh non-financial factors to judge the true quality of a profit. Things like staff morale, physical location, and market reputation. These aren't captured in a T account, but they are absolutely vital for evaluating the club's long-term sustainability.
Finally, Section 4, Avoiding Common Exam Pitfalls. I need to vigorously warn you about this one, because this playbook comes directly from the recent Principal Examiner reports. One of the most common ways students bleed marks is failing to distinguish between revenue and capital items. Revenue items are your day-to-day operational expenses. Capital items are your long-term asset investments. Listen closely. If you mix these up in your receipts and payments account, your entire profit calculation for the year will be hopelessly corrupted. Let's lock in this examiner checklist to form a protective shield around your hard-earned grade. First, write clearly in your ledger accounts. If examiners can't read your handwriting, they literally can't grade it. Second, show all calculation workings for those precious method marks. Third, accurately distinguish your revenue versus capital items. And finally, ensure 100% accurate, modern 2026 terminology.
We've built your framework, but let me leave you with this final thought. If your club's treasurer suddenly vanished tomorrow, leaving behind a box of mixed-up invoices and a plummeting current ratio, could you step in, spot the missing capital expenditures hiding in the revenue account, and save the club from bankruptcy? Go pull up a past paper right now and prove that you can.